Understanding economic bubbles, a historical perspective. Economic bubbles are periods of inflated prices in an asset class driven by speculative fervor and a departure from fundamental values. These bubbles are often accompanied by narratives of easy money, technological innovation, or seemingly limitless growth potential. When bubbles burst, the consequences can be devastating, leading to economic recessions and financial distress. From the tulip mania in the 17th century to the South Sea bubble in the 18th century, speculative bubbles have demonstrated the power of human psychology. One common element across many bubbles is the role of speculation. Speculation involves buying assets not for their intrinsic value, but with the hope of selling them later at a higher price. Loose monetary policy, such as low interest rates, can fuel borrowing and further inflate asset prices. By studying past bubbles, we can gain a better understanding of the warning signs and the importance of sound economic principles in preventing future crises. In the 1980s, Japan experienced an unprecedented economic boom. The country witnessed a surge in asset prices, particularly in real estate and stocks. Japanese economist. During this period, Japan's economy was experiencing rapid growth, and its currency, the yen, was appreciating significantly. As capital flowed into the country, it further fueled the rise in asset prices. The Japanese government implemented expansionary fiscal and monetary policies, keeping interest rates low and injecting liquidity into the financial system. Japanese economist. As asset prices continued to soar, a culture of speculation took hold, leading to excessive risk-taking and a disregard for fundamental valuations. The late 1990s witnessed the rise of dot-com companies fueled by the transformative power of the internet. Tech investors, captivated by the internet's potential, poured billions into dot-com companies. The stock market, particularly the Nasdaq Composite Index, experienced an unprecedented surge. The dot-com bubble was driven by technological innovation, speculative frenzy, and easy access to capital. Tech investor, traditional valuation metrics were ignored, and companies with little to no viable business models attracted significant investments. This speculative fervor created an environment where many companies went public with little to no revenue or profits. Section 4, A House of Cards, the U.S. housing bubble and the Great Recession.
In the early 2000s, the United States experienced a housing boom of unprecedented proportions. Home prices soared, fueled by low interest rates, loose lending standards, and a belief that real estate was a safe investment.
The housing boom had a ripple effect throughout the economy, leading to increased consumer spending and economic growth.
One key driver was the availability of cheap credit, with the Federal Reserve lowering interest rates to historically low levels.
As housing prices continued to rise, lending standards deteriorated.
Mortgage lenders offered exotic mortgage products to borrowers with poor credit histories, creating a recipe for disaster.
The housing bubble peaked in 2006, after which home prices began to decline. This led to a wave of mortgage defaults and foreclosures, which rippled through the financial system. Section 5, the common threads of financial bubbles, speculation, monetary policy, and human behavior.
Examining the Japanese asset price bubble, the dot-com bubble, and the U.S. housing bubble reveals striking similarities.
Speculation played a significant role in all three bubbles.
Investors, driven by greed and fear of missing out, bid up asset prices far beyond their fundamental values.
Loose monetary policy also contributed to the formation of these bubbles.
Low interest rates can create an environment of excessive risk-taking and asset price inflation.
Human behavior, particularly our inherent biases and psychological tendencies, played a crucial role in all three bubbles. Section 6, Preventing Future Crises, Lessons from Economic Collapses.
The bursting of financial bubbles can have devastating consequences for individuals, businesses, and the global economy.
Despite the recurring nature of financial bubbles, there are valuable lessons to be learned.
By understanding the causes and consequences of past bubbles, we can develop strategies to mitigate the risks of future crises. One crucial lesson is the importance of financial literacy and education.
Another important lesson is the need for greater regulation and oversight of financial markets.
Effective regulation is essential for preventing future crises.
Central banks and policymakers must also play a proactive role in managing asset bubbles.
Monetary policy can be used to lean against asset price bubbles by raising interest rates or implementing stricter lending standards.